Hello and welcome to the new episode of the How to Trade Like a Pro podcast. I'm Wieland Arlt, and this episode I am happy to welcome Ron William. Ron William is a renowned technical analyst and expert for financial behavior, and therefore it's reason enough to talk with him about the mindset of a professional trader. Before we start, please take a closer look at the risk disclosure in the show notes, and then we're good to go. I'm here with Ron William. Ron William is not just a trader, but also a very, very well-known technical analyst. And Ron, you have so many things. I'm just browsing through your LinkedIn profile and all your expertise. It doesn't stop. So you're founder of RW Advisory, you're a performance coach, trading psychologist, behavioral finance is something you're really keen on. So you're with the foundation of the study of psychics, you're development director. You've been on the board of the International Federation of Technical Analysts. Still, you're in the education committee, and I really hope so you're back on the board very soon. So I'm really, really happy to talk with you about trading, about technical analysis, about life, traveling, and everything that comes around it. Welcome, Ron.
Thank you very much, Wieland. It's an honor and pleasure to be catching up on this podcast and with you, with all the hats that you wear. First and foremost, as a friend and industry colleague, but also IFTA president and trader.
Yeah, thank you so much for bringing the time. And we just had a 1 hour chat before our recording, and it's always like that when we talk about not just trading. Basically, we don't talk about trading. We talk about everything around it, a bit organization management, life, and that's why I feel like it's time to go also into trading, into analysis, and that's why I just thought about a podcast would be great. So usually what I like to know about my guests is, how did it all start? Where was the beginning point for markets, for analysis, for trading, for stocks, commodities, whatever? Where did it start?
Early study years, with originally a passion for history, but through work experience while studying, I was offered a summer work opportunity, and here I pause and smile and say it was a labor of love arrangement. So right. I learned on the job, and my bonus was the knowledge that I learned, but in the end, years later, that became my first official starting point in the UK financial city. So looking back, it was meant to be. It was a part of the fate of life, and this journey that we're all on through different ways. The added story I would include is having great mentors along the way, to name a few: David Fuller, Robin Griffiths, and others that taught me a mixture of behavioral technical analysis in terms of the psychology of things, but also the cyclicality in nature and markets. These are key concepts that I've built along the way. And then the last point I would make is learning by doing. So actually trading and having skin in the game was always a very important stepping stone. And one of my first trades were probably my worst trades because I made money. And then the second time I traded, I lost what I made, and got involved in revenge trading without even knowing what that was. And then realized, later on that I needed to give this disciplined professional subjects due diligence. I needed to get to work and really take this seriously.
Yeah. I mean, what's interesting about this is, first of all, you started something around being an analyst, or, with all kind of techniques. And then you became a trader. Usually people go the different way. Like, okay, I'm hearing about I can do something in the markets and let's make money, like just going on, opening an account and just trade, and then realizing, oh, Like you said, I made profit, now I make losses, and now I make even bigger losses. How is this possible? And then they become analysts. And but from your point of view, or what I just learned is that it's more the different way. Is there a difference between being an analyst and a trader?
Yes, there is. That they're not exclusive. Both focus areas are not exclusive of each other, and I think most people will know that to be true. However, as I was once taught, you can be a professional in the art of both analysis and trading, and then you can also be an asset to clients who want guidance on the same thing, and so. Do by learning and ultimately offer guidance in what you do. It's a rarity, so it is something that few do well. But I think that the best way that you can connect the dots between both is to be track driven ultimately. And when I say track driven, not just in terms of outcome and bottom line results, i.e. the equity curve being positive, but also having a systematic process that the market and you can be accountable to. And so I think whichever side of the equation you're on, markets keep us honest, because ultimately, the price is king. And if the analysis or trade works, great. If not, you have a risk assessment, and then due diligence follows. I've always been interested in both. I've always been keen to have a big picture, strategic view on world markets, understand the cause and effect, and not just apply it to markets, but to the economy and to related trends. And on the trading side, it's always made sense to develop that skill, both for myself and for clients.
Yeah. Yeah, I mean, I'm asking for that reason because, there's sometimes, especially if you're with traders, also especially with retail traders, if you're like, it's so easy to do trading and I don't have to apply technical analysis in such a big way to understand really everything. So maybe support and resistance and I'm good to go. But as we both know, there's more to experience and also there's more to discover and more to learn. And I'm pretty sure you will agree that this learning will never stop. And even though you feel like you know everything, market teaches you different lessons, right? What do you think about this?
Absolutely. My first official independent research advisory role, servicing top financial institutions, was in the currency emerging market space. And I can tell you, I had my technical analysis and trading recommended reading on the desk. And I was just speaking about this with some industry peers yesterday, literally. We were exchanging memories from the past in terms of our journey. And the point I was making is that I did read, study, and follow the rules and the guidelines. But then when I was in the seat, analyzing what proved to be very volatile and uncertain markets, I had to take a bucket of salt and shake it about through my own experience, for better and for worse. And that's where you learn not just the rules and the guidelines, but the exceptions. And most importantly, you gain a self-awareness as to what works for you and how you can ultimately be in this peak performance mindset to get the best results.
Mm-hmm. It's also interesting because now you're talking also about mindset. I mean, we're coming from support and resistance, and in a minute we're talking about mindset. And I really love the idea because as more as more experienced you are as a trader, you realize that of course you know the basics. You also know some sophisticated ideas about technical analysis, but at the end, especially if you go in short term, I think it's very important also to distinguish. If you go in short term, mindset is key, right?
I would say mindset is key across the board, and this became more prominent in my thinking through training that I did with lead trade psychologist Dr. Van Darp, who since time has passed, but his work lives on. And I train for their organization, the Van Darp Institute. He always taught that there was an 80-20 success equation, where 80% is psychology, 20% is mechanics. In the later years of his life work, he then changed it to 100%. I said, what is the change in the split? And he genuinely believed it was everything. So not to say that the mechanics of trading, risk management, money management aren't important. They are, but ultimately the person that drives them is as important, if not more. So that's the first point I would make. The second thing is, what he often said is that people don't trade the markets, they trade their beliefs. I'll say it one more time because it sounds a little bit of a mind twister. People don't trade the markets, they trade their beliefs. And so again, it isn't saying that we don't trade markets, because clearly we do. But when we do, it's the perception of the data and the market move and the volatility that we trade. Once it filters through your mind, my mind, and everyone else's mind, that's what creates the nuance. And so it's really important to have a level of self-awareness on that point. And the last recommendation I would give people, again, based on the same work, is to think about you, the system, and the environment. This is also part of Dr. Tharp's work, where he recommends an alignment of all three. So you is the part we're discussing, the mind, the psychology, better self-awareness of you, know thyself, what works for you might not work for me, and so on. The system, developing a system that doesn't just have amazing performance, but it has performance that works for you. Right? A trend following system works for one person, a mean reversion system might work for another person, or maybe someone can mix and match both. But it's important to understand that there's alignment between the system and you. And then finally, no system works all the time, every time. And this is something that we've woken up from our amnesia in the just year or so, because market environments have changed. We no longer have this kind of strong trend, low volatility environment, which was the case in 2021. We had a big regime change. We had an inflation shock, and that's created all kinds of new paradigms. And so the new environment is one that we have to continuously watch in order to adapt and evolve in. So remember those three factors: you, system, and environment are always going to be key.
Yeah. I mean, you bring a lot of things together now, and especially for people just starting trading and also technical analysis, it might sound a little bit complicated, because we are talking about, of course, we're always talking about technical analysis, and then also it comes a little bit fundamental aspects into it in terms of, okay, now we have some more inflation coming in, economical things change, and also we're talking about the mindset. So as a trader, so many things come together, and then you just see markets moving up and down. And of course, we're talking about psychology here as well. When you see everything's coming up and down, and maybe you want to make a profit from it, you want to have your advantage, so you jump just right in, forget about inflation, forget about technical analysis, you just go into it. So especially as a beginner, what should I start with? Analysis, technical or fundamental, mindset, techniques, strategies, management? So many things come to mind when it's about that. So what is your opinion on this?
It's all important. And another way of saying that is the sum of all the parts. And certainly in my work that I do as part of the education team for IFTA, International Federation of Technical Analysis, for those of you who are new to IFTA and want to learn more, I've always argued that a strong education syllabus is a sum of all its parts. And so, for example, one of my specializations is both behavioral finance, but also cycles. So I've always, had a strong view on developing those two areas more. Same thing when you're starting out in the industry and you want to learn about trading, or you maybe want to develop your career in a financial institution with this skill. Whatever your goal, understand that each of these principles and learning curves are connected and are important to learn them as a whole. Yeah. I wouldn't say one is more important than the other and start developing this hierarchical system. A lot of people like to think like that. Certainly, I would say risk management is paramount. Whatever strategy you use, whether it's macroeconomic, whether it's fundamental, whether it's technical analysis, your risk management is going to be everything. And I would add to that your exit is likely more important than your entry. And some traders get quite frustrated when I say that. They say, what do you mean? So my entry isn't important? Of course it is. The earlier you enter the trade or the investment, the more profit you can build. But the risk of ruin mathematically is just such an end game situation if you do not manage it well enough. And again, last year, for different reasons, that was a case in point. So anyone who is just buying on the dip, buying the dip, which is what people did in 2021, suddenly realized that strategy doesn't work all the time because we didn't have that strong trend, low volatility environment. We had a directionless bear trend with high volatility environment, number one. And then number two, people who are looking to buy and hold or do a diversification portfolio, 60-40, 60% in equities, 40% in bonds. All of these tried and tested strategies stopped working as well as they did before. So my point is risk management and understanding the importance of market timing and the change of regime is ultimately the top thing. How you apply your analysis or your trading strategy is really unique to you. So I've always had a blend of macro, fundamental, technical, driven by technical, and grounded in market timing. But if you look up the works of the Market Wizards series, you'll learn that there are many different experts out there with different specializations that make money in different ways. So I don't think there's one way that is better than the other, although technical analysis is the most responsive and adaptable of all.
True. I mean, Market Wizard series is amazing when it comes to learn about all the experiences and also approaches of the big names. I mean, the industry knows for years and for decades. And I highly recommend this as well. I have another idea or another question in mind or another point, because you mentioned, Ron, that literally the entrance doesn't matter at all. And the exit is king. And I totally agree. Let's say just a game of thoughts. Let's say we use a random entry. Somebody tells you, okay, buy. Somebody says sell. So for whatever reason, you just say, okay, you tell me if I buy or sell. And I think that no matter what you do, if you buy or sell, if you're right or wrong, proper management saves you and can make even the worst entry at least break even, if not profitable. If you place your stop loss right and also take care of your position sizing. What do you think about this?
Yes, and yes and no. So yes to risk management being important, times two. Yes and no to entry not being important. Good entry is good entry. So what I always say is aim for the sweet spot, the best of both worlds. Good entry and good risk management. Warren Buffett says predicting rain doesn't count, building an ark does. And he's that is wisdom to say that, hey, you can say that, markets are going to go down tomorrow, volatility is going to spike through the roof. But ultimately, what's the strategy? And how are we going to reflect that in a trade or in a portfolio? So it does need to be actionable, and it does need to be include risk management. And a reflection of that, by the way, is work that has been done by various leading institutions. Most recently, that was Goldman Sachs, where they did a test of strategies to see which one was the best performing. Those, and I describe it as FOLO versus FOMO. So everyone knows that FOMO is fear of missing out. So fear of missing out, if you were to miss out on the best trading days, your equity curve would be, relatively speaking, a steady, almost flatlining uptrend. A steady, almost flatlining uptrend. If you buy and hold, that outperforms FOMO. If you follow my visual description for those of you who are listening to us and not watching my body language signals. And then the third one is the real outlier surprise that no one expects. The line on the chart in terms of equity curve performance that looks like it's going up in a straight line is FOLO, fear of losing out. If you have a healthy fear of losing out and you have good risk management, or you don't trade on certain times in the year when it's just too crazy and it's not prudent, so you can decide to risk manage that or just to not be in the game for a limited amount of time, your equity curve will outperform significantly. Now, again, does that mean that you forget the best trading days and the best trading ideas? No, it just means that you be aware of the importance of both, and that between the two, risk management is critical.
Right. Yeah. I love the idea of fear of losing out, because if you really avoid high volatility days where you don't, where you're not really sure how to trade it, or some news events. I know a lot of people trade news because of the volatility, but a lot of people lose money because of that, the volatility. Maybe they enter the markets too early and they get stopped in and stopped out at the same moment, or for whatever reason. And if you realize in your trading journal, these are the days where you make the biggest losses, or most likely you make your losses, it's a good idea to skip these days. And also, right, from the journal wise.
Absolutely. I'm a big believer in journals. Practice by doing, and then ended up customizing my own. And then for students that I mentor and coach, ultimately, it's important to be accountable, and that's what a journal allows. But also, it gives the space for both quantifiable information, but also capturing the psychology of things. You can't capture psychology in a number. You need a space to write your thoughts and triggers to certain trades. So journaling is great. What I would say on the risk side, because this is a popular question I get asked regularly, how do I decide, the strategy for stop loss or for risk management? That's a whole podcast in itself, of which I'm sure you've spoken to many smart people that have their own views. The three quick things I would say is to have a hybrid stop loss risk management system that includes a technical chart level or behavior, a statistical volatility based average of some sort, which I'm a big believer in. So ATR is a case in point, which is quite popular with many traders out there. You can choose what multiple of ATR to use or blend. And then finally, something that is financially linked to your account so that you know how much you're risking on the table is always prudent. And whenever a trader says, hey, I'm losing sleep on this trade, my response is dial down the risk. Mm-hmm. You don't have to leverage at all. Have zero leverage. Main thing is that you build up consistent tracks so that you can be confident in your trading approach, and then ultimately develop that positive equity curve. And then over time, you can start to leverage and master position sizing. That's where the real money is made. Mm-hmm. But we have to walk before we run.
Mm-hmm. True. I mean, regarding stop loss, there are always some different ideas on this. And I had like a couple of episodes before, I was talking with Tom Starke, and Tom says, no, I don't use a stop loss at all. And I felt like, what? And he explained it to me, and it sounds sounded pretty reasonable, but the whole approach he chose was a different one, like most retail traders do. So what he does, he just opens a position and adds, and he adds position sizes and he lowers position sizes. So what he does is exactly what you mentioned. Okay, if you don't sleep well, just lower your position size. Erase the lever, right? So don't have any lever at all. And under this perspective, I felt like, yes, this could be an idea, but of course not if you go in with futures or intraday, but it could work if you go in for like as an investor or let's say midterm at least. What do you think about that?
I think you hit the nail on the mark there, Wieland. It's case dependent. There is no one size fits all. With any strategy, whether it's market strategy, trading strategy, investing strategy, particularly when it comes to risk. So to be more practical and to circle back to what you said, are we talking about a trader versus an investor? Are we talking about different, which market type are we talking about? Futures, cross assets like FX or even crypto, and then ultimately, what works for you? I know traders that apply stop loss, but they don't use it. So they actually apply it, but they don't use it. I don't mean that they ignore it all the time, but there are times when they think they're on a big winning trade. They put the stop loss in, and then they report back to me as part of a coaching work, and they say, I say what happened, and in their journal they say I ignored my stop loss. So even those that do have a stop loss sometimes bypass it and decide that that was the time to do it. I think the other thing, so the first thing I would say is whether you use it or not, be consistent. If you're going to use stop loss and risk management, use it. If you're not going to, and you've tried and tested that approach, follow that. What I notice more and more in this industry, especially with first timers, is inconsistency. And I would say inconsistency is a real killer. It's the silent killer. We don't talk about it as much, but it truly is a silent killer. It does kill in the end, but because it's subtle and maybe because it's just not so overtly obvious, it creeps up on us over time. The market condition, I would say, is another thing, because another debate people have with me, which circles back to the same point about risk, not risk, but profit.
Yeah.
There's a whole debate. Do we take profits, or do we let our profits run?
That one. Oh, yeah, for sure.
Right. I would say if you have a strong trending market, you can let your profits run. Mm-hmm. If you have a sideways high volatility mean reversion regime, take care, because letting your profits run may sound good in theory, but in practice, you're just it's death by 1,000 cuts, either on the stop loss or on the profit. Yeah. You make a profit on the screen, but not in your pocket. And so again, the answer lies in the condition, or the case, not in a fixed rule.
Right. Yeah. It's so true. I mean, these 2 points, like stop loss, yes or no? If so, where? And the question comes to mind, why do people ignore it? If they decide for it, why do they ignore it? We will talk about this right now. And also the question, where to exit with a profit? Because, and then greed comes into play. So if you're like, this is the trade of my life. Maybe yes, maybe no. Most likely no. So how to do this? Let's start first with the stop loss. Why do people really feel like, okay, right now I don't take care about my stop loss, I delete it? Why? From the psychologist side.
There's a bunch of reasons. I think on one level, which is more of strategy than psychology, I think it's the impression I get from case study examples that I work with on a regular basis. And this is true of my own experience when I started out. We don't know what we don't know. So when we start from kind of a point of lower awareness, and we don't have a kind of a clear structure and a robust technique, what happens psychologically is that we lose confidence in the approach that we are applying. And confidence is key. Successful traders are confident in their strategies. And confidence doesn't stick with you day to day. It fluctuates. But they know when they're on a high probability trade. They've tried and tested many setups, and they are confident in the approach, even if the approach wins or loses. They're confident in the approach. And so many people who are new to the game and haven't had enough runway time, or let's say robust and systematic learning, question the very approach that they're using in the first place. And so that leads to confidence issues, number one. Number two, that then triggers fear. Ultimately, it's a cyclical, slippery slide, and fear is something we are born with. We are risk averse as human beings, and we are fear driven. I always like to lighten the mood when we talk about fear and say fear is healthy. Without it, we would not be fearful about jumping off a cliff, although I know some people love that. Bungee jumpers or paragliders. Yeah. And I was stopped in an IFTA conference some years ago by a prominent technician, naming no names, who said that he regularly had adrenaline hits when he was in a high risk situation, and that was part of his edge. So, different things work for different traders, but as a rule, we are more risk averse and we are more fear driven. It is healthy because it keeps us alive as human beings and as traders. Plus, it allows us to evolve. Fear actually leads to evolution. If it wasn't for fear, we'd be stuck in the caves, not knowing how to survive. Mm-hmm. And I would say it's a very useful metaphor for trading in difficult times. Where fear becomes an issue is where it takes control, where it overwhelms us basically, and it blindsides us from the opportunities, and it leads to this kind of negative spiral of analysis paralysis, core loss, stop loss management, and ultimately blowing up the trading account as a consequence.
Mm-hmm. Yeah. So it's a fear that keeps us alive, and it's a fear that kills us. So both is really, really important to understand. So that once you feel like, oh God, I have the fear of losing, and I know this myself. That's why I'm that's why I wrote a book about it, and that's why I always talk about this, because if you have the fear of losing money, there's two things happen. First of all, you take the event yourself manually, right? Because I can't help it. It will be a loser. I exit the trade right now. So the fear of the loss makes the loss, first of all. And second, I don't want to lose money. I just, I delete the stop loss. There's no stop loss anymore because markets bounce back, but maybe not this time. So these two things are really those one who destroy your account, from my personal experience, of course, also from what I experienced from others, and to make it even worse, to add on losing positions.
Yes, and certainly, all of them is a negative spiral. I would say one to add to that for those who are interested in this area is denial and acceptance. Two really important principles that all traders and all living beings can and should embrace. And according to the work of a Swiss psychologist, Kubler-Ross, she did research on patterns of bereavement, which I know is a heavy subject, of course, and respect to all those that are going through difficult times on this topic. But interestingly, it applies also to shock experiences, not just death, and also trading, where we can have traumatic days in the market and bereave portfolio losses, as I often teach students and share with clients. as part of that process, we begin with shock, shift into denial, then frustration, a little bit of anger where revenge trading pops up. And then we cycle down in the slippery slide into the abyss, into basically the lowest point of the cycle, but the lowest point that leads us to the highest point. And that is through what I describe as dealing with the lows in order to embrace the highs. And the low is acceptance.
Yeah.
And the high is basically lessons learned and best practices, growth mindset. And then we basically become more successful in both life and trading. The issue with most traders I work with, traders, investors, and also in my own experience, is we get stuck in denial. We actually don't make it to the rest of the stages, or we get stuck in the heavy emotions of frustration and anger, and that's it. Whereas other traders tend to know how to deal with the losses a lot more. They learn from it, especially if they have their journals, whether it's a trading blotter or a physical manual, kind of written diary type journal. And then they're very responsive to change and to developing patterns of change so that they can grow and ultimately be more resilient, more adaptable as traders.
Yeah. Yeah. So everything is about development. And what you mentioned, this is something I read somewhere as well, that when it comes to money, that the human beings are not built for that. We cannot cope. We cannot deal with financial losses. So it triggers some area in our brain which is connected to physical pain as well. And this also makes perfect sense when it comes to grief, right? So we go into stages we cannot control, really. Like it's just a process just that cannot be stopped anymore. So and this is why, from my point of view, that is why, and that's the reason people really freak out when they get into the loss and make everything worse by misbehavior.
And it's a combination of different factors, right? A whole immersion experience. So we're talking about psychology and behavior, but there's neurological, there's physiological. One of the areas that I've recently been specializing is the neuroscience space, and that helps us develop rational and logical models for why we make the decisions that we make in high performance situations, not just trading, but also sports or even life or death situations like being in the military. And the research shows that when we are under distress, not natural adrenaline rush stress, but distress, extreme chronic stress, the logical part of our brain, the front side of the brain, if those of you who are listening, just put your hand on your forehead, the prefrontal cortex, PFC for short, shuts down. It goes into semi-paralysis mode. So no matter how smart you think you are or how successful your strategy might be, we start making illogical, subpar decisions, mistakes ultimately, and then that gets reflected in the equity curve. So the emotional alarm bell goes off, the amygdala, the stress response, that then has a knock-on effect onto our decision-making process. And all of this is part of the process. And some people experience their adrenaline spiking, sweat, shortness of breath, headaches. There's all kinds of, psychological, behavioral, neurological, and physiological experiences. This is why I think it's as heavy a subject as it is, it's quite exciting for us to learn about it as an immersion experience, so that we can do something about it. I believe that we can bet. It's not something that we change, because it is part of being human. It's the human experience, which I think ultimately is an asset. But it is something that we can better manage and optimize. And then all you have to do is look at the sports world. The top athletes do this as part of their professional work.
Okay, got it. Is there something like a trader burnout? Is this possible?
Absolutely. Burnout exists across the board.
Yeah.
And sometimes the worst burnout is when you least expect it, or when it creeps up on you and it's not clear, because it's a surprise factor which it catches you off guard, and ultimately you're not prepared for it. But yes, absolutely. Research shows that taking a 15-minute walk, i.e., walking away from the chart and or the trading screen when it's safe to do so, I might add, and just going for some fresh air, or doing something that raises your endorphin levels, is a game changer for resetting all of the different factors that I just highlighted. Just 15 minutes. And so some people say, hey, quality time with the family. Other people say, a round of golf, walking, running, meditation, yoga. Everyone has a different experience that elevates their mood. But ultimately, I think it's a combination of elevating your mood, but also emptying your mind a little and detoxing. Because a lot of people, whether it's professional analysis or trading, investing, we suffer from information overload. Slightly different topic, but it still relates back to the same thing. It leads to excessive stress, and ultimately we need to learn how to deal with stress and be more responsive to stress.
Yeah, it's really important to understand, and also I learned a conversation about it, because I think most of the people even don't know, they don't realize, and they don't talk about it. Because this is really the downside of trading, of being a trader, especially short term, like intraday, from my point of view, right? So that it really feels like, no, I'm not born for this. Humans are not built for this, and we go into on our own will, we go into in situations we don't fit in, and we set ourselves under such a huge stress. And most people don't realize it. And if you ask your environment, and if your environment, let's say your family says, why are you so upset? You just were just at the computer. So what is going on? They don't even know.
Right? Absolutely. And so having a circle, a trusted circle, let's say a trusted support circle, is very useful. That can be family, friends, or a trading buddy. And at basic, and I would say best would be a trained and professional mentor or coach, which is the work that you and I do, in addition to our trading and analysis. So a lot of people need someone on the outside, looking from the outside in, who is trained in that space, but also trained in what to do, in how to support and facilitate support is key. There's a lot of self-work that can also be done, and so trading journals is one. I think most people tend to be prone to trading blotters. I speak to a lot of traders who are very left-brained, very rational, very logical, and that's good. They tend to, crunch data very well, and they're very good with knowing their numbers. But when I ask a psychological, emotional, behavioral question, there's usually this pause. So I encourage everyone to get back in touch with their ego, with their emotion, with their thought process, because it's all interrelated. And when you do that, you create some space, safe space, to reflect and to ultimately grow. I think that there's an industry conditioning maybe that you just keep on keeping on, crunch the numbers, but don't have that safe space for reflection. And I think that's a misunderstanding to the work that we do. And there's lots of research that shows that having that reflection time in a constructive and progressive way is very useful.
Yeah. So one question just crosses my mind in terms of that. Also, the acceptance, also the acceptance from the environment. Also, there's something like if you really have a bad day, you lose money. There's something come into place. It's also like shame, like I'm sitting in front of my screen, instead of making money, I'm losing money. So it would be better not to sit there. So, and all these things, and then you have to report maybe to your family, maybe to your boss. So wherever you're working, what environment you're working in, and then you just feel like total jerk in being a loser. And this is something I feel like, especially private investors, retail traders, are very familiar with. What do you think about this?
It's a tough emotion to deal with.
Right.
I mean, on different levels. One being wrong. Mm-hmm. Who likes to be wrong, right? I once asked a parent, what is your experience of the concept of people making mistakes and being wrong? And this is a financial professional who was also a parent. And he said to me, well, I have kids. And, I can tell you from being a parent, our kids are brought up not to make mistakes.
True.
Particularly when they go into the school system, if you make a mistake, you don't pass your exam, you fail. And the people say, well, it's a question of IQ. There's nothing you can do about it. There's all kinds of lifelong misperceptions out there that we are influenced by that don't support this concept of learning by doing and failing forward. So we're not talking about failing backwards. We're not saying celebrate your failure. We're saying, you're going to learn the most from your failures, from your mistakes. And in doing so, you can fail forward. You can take a leap ahead. So there's that side to it. The other point I would say is it's important to create the safe space to learn from those failures, from those drawdowns. Make sure you're documenting them down, and then also to manage expectations. A lot of people, one of the opening questions I ask is, what do you think is a profitable hit ratio or win-loss ratio? Mm-hmm. And there's many different responses to that. My anecdotal number, if there is a magic number, is 51%. And they say, why 51%? It's like a holy grail number. And I say, well, look, it's close to the coin toss territory. Mm-hmm. Toss a coin, heads or tails, it's half probability. Yeah. But the 1%, just to check everyone's ego and expectation and let them know that you can be the best trader in the world. And generally speaking, the statistics show that you have a half chance of being right or wrong. Prediction works some of the time, not all of the time. And it's about a 50-50 split. But what makes you different as a trader is that 1% edge. So that's why I always say 51%. But people expect 60%, 70%, 80%. Some people say even higher than that. And you can have days where your profitability and your predictability are higher, but work on the average and work on the probability of half or 60-40. That will, I think, keep you more focused and clear-minded, systematic, and let you understand that losing is part of the game. And the last point I would say is, losing is part of the game. How do profitable traders make money if it's a 50-50 win-loss or 51 or 60%? How do they make money?
Yeah.
I'll throw it back to you, Wieland. In your experience, how do we make money? How do other traders, you, me, and others, make money if it's a 50 ratio or 60% win-loss ratio? There we go. But does that mean we let our losses run?
No, of course not. Right? That's the point. So you have to make sure that you have a decent risk-reward ratio. But the point is, if you're too greedy with that, you will have a lower hit rate. So, right, by definition.
Right. That's another point. Yeah. And ultimately, I learned this actually from a few market wizards, and credit to Linda Raschke actually for sharing this in an IFTA interview that we did together for one of the recent conferences that she spoke at. And she had what she called different business portfolios where she would apply different strategies and different expectations of strategies. And so I think that's something worth thinking about. Some people are just, they like to keep it simple. They focus on one market, one strategy, or several markets, one strategy. Fine. But if you can think about a diversified approach where you have different strategies that work, in different ways, that's when you can start to then apply more adaptable systems and thinking, where the win-loss ratio will change, and your risk reward will change, partly because you're dealing with trending markets which are trending more, remunerating more, or some other variable factor. But to keep it simple, I would just say, remember that the best of the best work are 50 to 60% in the win versus the loss. Point one. Point two, that then means you need to deal with the loss side, because if you can minimize your loss, in the end, you're going to hit the win. And then the third point is, it depends what system you trade, exactly what you just said. So credit to you, Wieland, for circling back to that point. The market and the system you trade is ultimately also going to influence those numbers.
Totally agree. Great. Ron, I'm just looking at the watch and time is running. So as a last question, and I'm pretty sure it's more or less a summation of what we are talking about. So I like to ask you for the one really important way to go for a beginner, for somebody really wants to start trading. And as it is, they always want to start short term. So what do a new trader and novice has to take care for? What will be the first steps from your point of view?
Learn as much as possible. Learn by doing. So learn by researching and by attending professional courses, whether you decide to do the certification route through IFTA as a choice, or you can do a professional training by professionals in the field. These are good choices to consider. So learn in the best way in terms of external learning, but then I would say internal learning, learn by doing, because ultimately that's only when the knowledge turns to action, and experience builds with time, and that has to be your experience. Whether you're trading manual, discretionary trading, or whether you're doing half or fully systematic, you need to own the experience. And I would say that's the real distinguisher in my mind in terms of those who are starting in trading versus the more senior ones who have the battle stories to share. That's what makes you a resilient and successful trader. So learn through external sources, learn by doing, and build up that track and experience and some of those battle stories, which will allow you to succeed in different market environments, especially the interesting ones we've had recently. And the final point I would say is be very clear on your why. Know why you're trading, because the one thing that tends to happen pretty fast is that when the going gets tough, the tough gets going. So if you really are serious about trading, be very serious as to why you're trading. Maybe it's money related. That's typical and that's normal. But then why is that money important to you? What is behind that goal? Is it a lifetime, a drive? Is it a skill set that you just want to build? Is it a career progression? Whatever it might be, just be clear about that, and develop a roadmap as to how you want to achieve it, and make sure there's a process to that, and it's not just a bottom line target, because a lot of people get burnt out because they have a magic number in their head, and if they don't hit that target, they basically think that they're failing and that they're not succeeding, and it tends to sabotage the process. So make sure you are aware of the importance of both. Yes, You need to have a performance goal and a monetary outcome. But as important, if not more important, is how you get to that target. You need to have a tried-tested, evidence-based, systematic approach to money, and most importantly, to matters.
Beautiful. Excellent. Well, wise words. And Ron, thank you so much for all the insights and, well, the depths of that what we can learn or could learn from this chat for this interview. And I'm very sure that we will continue with that one very, very soon, because there's so much to talk about when it comes to trading, investment, psychology, mindset, all the other stuff. So I'm really, really happy for this one and for more to come. Thank you so much, Ron.
Thank you. It's been a real pleasure. I look forward to the next one. All the best, Wieland.
That's already it. And I really hope that you enjoyed this episode and you took away some learnings for your personal trading. If you want to learn more about me, about my interview partners, if you want to have a one-on-one coaching or even get into a training course with me or my interview partners, just get into the show notes and follow one of all these links you find there. And then I will be happy to hear and see you again. Your Wieland Arlt.